95% of traders, which means most likely you too, is stuck at the very surface level of fundamentals. NFP, GDP, CPI, Forex factory calendar stuff, all of that. But the truth is that it's all nonsense if you don't look at it with the proper framework. See, the problem with most traders is rarely about technical analysis. Nowadays, we all know how to read a chart. It doesn't take a master's degree to do that. There's countless of content out there teaching you all sorts of technical aspects. But the fundamentals, well, that's another story. And it's one of the most important stories, actually. See, at any given moment in time, if the market is trending, there's a story and a fundamental narrative driving that trend, a macro flow, a sentiment, whatever you want to call it. Understanding that narrative is what fundamental analysis really is about. It's not knowing the GDP of New Zealand to the third decimal. That's not what it's about. For us traders, fundamental analysis is a totally different thing. So for the next 30 minutes or so, I'm going to distill a decade of my experience in fundamental analysis directly into your brain. We're going to dissect the real machinery that moves billions of dollars around the globe every single day. By the end of this video, you won't just see the charts, you'll see the fundamental story behind the chart, the forces driving those big trends, and you'll finally understand how to use fundamentals not as a dusty textbook, but as a powerful tool in your training. So first of all, as you can see, I'm on Forex Factory right now. This is what 95% of traders call fundamental analysis. Let me make it very clear. Fundamental analysis is not only about economic data. And you'll see what I mean during the video where I'll teach you how to navigate the macro landscape the right way. But in short, the very first step to understand is that we don't need to look only at the economic calendar. And also we don't need complex spreadsheets tracking hundreds of economic data points. For our purposes as swing traders, we only need to be masters of the big two. Because the number one rule of fundamental analysis is that if it matters for the central bank, it matters for markets. So in general, what is that matters for a central bank? Well, most central banks, like the Federal Reserve, operate under a dual mandate. They need to keep inflation low and stable, but they also need to keep the economy strong enough to support the labor market. So inflation and labor market. Now, obviously, it's useful to have context of GDP, PMIs, retail sales. It's useful context, don't get me wrong, of course. But practically speaking, I want you to be a master of these two first. And then you can add more nuance to it. So with that said, I'm not going to bore you with the definition of CPI, NFP and such. I want this video to be as practical as possible without spending too much time on a technical definition, which you can really judge GPT in seconds. So I'll take for granted that you know at least the very basics of what is a CPI number, what is an NFP, and all the other inflation and employment metrics. Okay, now we understand the data the central banks are watching. We can understand and most of all anticipate their decisions because the central bank's policy isn't random. It's a reaction to the economic data that they're watching. This is what is called the reaction function. Now, as you can see, the information that often you get about these terms can be very confusing, This is all academic jargon. It's much simpler than that, okay? The reaction function is simply the way the central bank is prepared to act. As mentioned, most central banks operate under a dual mandate, inflation and employment, which means when we listen to a central bank speak, we should try to understand which side of this scale they're more worried about right now. What is it that worries them more, inflation or labor market? That's their reaction function. Now, where am I going with this? Well, let's go back to the Federal Reserve in 2022. Inflation shoots up, goes up to 6.6% core yearly inflation reading. Powell makes it explicitly clear. The only focus is on crushing inflation, even if it meant causing a softening of the labor market.
The overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular. To achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market.
Every speech, every press conference, he hammered this one point. And so the guidance was clear. As long as inflation was high, the Fed had its reason to hike. The result, the strongest dollar rally in, 20 years or so. But keep following here. So this was a Federal Reserve that was worried only about the inflation side and willing to weaken the labor market to bring down inflation. This is what we call a hawkish central bank. Now, Fast forward to August 2025, and Powell now says,
Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024.
As you can see, the scale has tipped completely the other way. Inflation is not a concern anymore. The labor market is instead. And this is the complete opposite. This is what we call a dovish central bank. Now, pay close attention to what I'm about to say because you'll soon see why it's important. Basically, a central bank wanting higher interest rates, whether that's to hike or to just keep them high, it's a hawkish central bank. So again, think about the Federal Reserve in 2022, worried only about inflation, willing to weaken the labor market, want to keep rates high, as hawkish as it gets, hiking rates meeting after meeting. Meanwhile, a central bank wanting lower interest rates, whether that's to cut rates or to just keep them low, is what we call a dovish central bank. Think Powell in August 2025. Okay, with this in mind, let's get one thing straight, because this is foundational. It's where most traders miss the entire point. See, 95% of traders focus on the action from a central bank, the actual interest rate hike or the actual interest rate cut. And yes, those are important. But a central bank's most powerful tool, most powerful weapon, isn't the interest rate move itself. The Dovish speech from Powell, gave in August 2025, wasn't an interest rate decision. The Fed didn't hike or cut on this day. Yet, look at how the dollar reacted. Now, this was a simple speech. It wasn't a change in interest rate. And yet the dollar tanked something like 120 pips or 150 pips. I mean, think about it. The market doesn't move only when a central bank hikes or cuts interest rates, okay? Because after all, they make the moves only once a month, sometimes once every 2 months. Sometimes they don't even move, they stay on hold. And yet the market moves every single day, not just on the interest rate decision. Where I'm trying to go with this is that if you focus just on what happened, so did the Fed hike or cut? Did they cut 25? Did they cut 50 basis points? If you limit your attention to that, you're already behind. In fact, the most powerful tool for a central bank isn't the interest rate move itself, it's their words. It's something called forward guidance. Central banks don't want to cause market wildness, okay? They don't want to cause troubles. So they deliberately leak their intentions, so to speak. They give you hints, whisper, nudges to guide the market. They want you to know what they're going to do next. And that's why the market prices in their moves in advance. And so speeches are crafted to send a specific message. Now, often central bankers try to send a balanced picture, neither too hot nor too cold. They like to be master diplomats. But about 60% of the time, the language is binary. It's either hawkish or dovish. So either they're worried about inflation being too high, maybe they're worried about growth overheating inflation, and so they want to hike rates or keep them high. This is hawkish. Or, on the contrary, they're worried about the labor market, and they want to cut rates or keep them low to support and stimulate the economy and the labor market. So, here's the meat of it all. Hawkish is bullish for a domestic currency because it hints at higher interest rates ahead because of a stronger economy or a heating economy, whatever. Dovish is bearish for the domestic currency because it suggests lower interest rates ahead because of a slow economy, whatever. In simple terms, think of it this way. Funds tend to flow where they earn the best return. If interest rates expectations in Europe rise relatively to the US, holding money in the euro becomes more attractive than holding it in USD. As a result, demand for the euro increases and demand for the dollar decreases. So that pushes the euro higher against the dollar. This is what we know as the interest rate differential. Now, I bored you enough with all the theory, so let me show you some action. For weeks, various European central banks officials talk hawkish. As you can see, they're worried about the upside risk in inflation, and they're not worried about the downside risk in growth. This, which is pretty much a labor market. So for that reason, they are projecting to keep rates high and to avoid rate cuts. This is hawkish talk, and it's bullish for the euro. Meanwhile, Fed officials in the US are on a more cautious dovish talk. They're hinting at an upcoming rate cut. Think about this. It's completely the opposite of what the European Central Bank is saying. Now, listen closely here. Did anyone here move interest rates yet? No. In this chart, there was no central bank interest rate decision whatsoever. It was all talks, all forward guidance. Understand where I'm going here? If you want to understand how markets move on fundamentals, you need to learn to look ahead, not behind. Most traders wait for the actual interest rate decision, but that's wrong. Markets move on expectations. If a central bank is telling you right now that they're going to keep rates high and the other one is telling you that they're going to cut rates, then there is no reason for the market to wait. It has all it needs to start pricing what's likely going to happen ahead. Remember, markets move on expectations. It's not just the current interest rate that matters, but also the expected rates ahead. Markets are always looking ahead. So if there's something that I really want you to take away from this video is this. Markets move on expectations. So if a central bank today says that in 2 weeks they'll start cutting rates, when a central bank says it like this, rate cut could be on the table, that's the way to say we're going to cut rates. So the currency will start to adjust accordingly today, not in 2 weeks. Understood? So at this point, with this context, your fundamental bias is set. The European Central Bank is hawkish, the Federal Reserve is dovish. So when in a context where the euro should be supported and the dollar should not be supported, so the path of least resistance for EU is up. And in fact it was. This little example is a taste of the most powerful, cleanest and most reliable trend generator in Forex. A monetary policy divergence. As explained earlier, big money, big funds that actually move the market, chase yield. They're constantly looking for the best return to their capital. So they'll borrow in a currency with a low or falling interest rate and park the money into a currency with a high or rising interest rate. This allows them to generate the so-called carry trade. And on top of that yield, they also profit from the currency exchange fluctuations. So the currency with lower interest rates tends to weaken against the currency with higher interest rates. And so they get the best of both worlds. A positive carry plus the currency appreciation. Now watch this. This is the US interest rate in blue versus the Bank of Japan interest rates in orange. Now the Fed was on one of the most aggressive rate hiking cycles in decades. They were screaming hawkish, hiking interest rates meeting after meeting. The Bank of Japan instead, they were doing absolutely nothing. The rates were flatlined. So you have one central bank paying more and more toward its currency and another paying absolutely nothing. So where do you think big funds are going to flow? Interest rates in the US flew to 5%, when in Japan they stayed to 0%. And so the path of least resistance was a one-way street for USD/JPY. Now this is a solid trend. This is a clean market trend generated by the monetary policy divergence. Do you understand what's going on here? Big funds were getting paid 5% a year to hold their capital in dollars and 0 to hold it in yens. So a lot of capitals moved from the yen to the dollar in that process, seeking the carry trade, seeking the yield differential. And now, here's why this is powerful to understand. Knowing this macro context with the monetary policy between the two, knowing that USD/JPY was likely to trend higher because of this ongoing fundamental sentiment, this doesn't give you only a trade idea. It gives you a directional bias in which to trade for months. Every dip in this trend was an opportunity to buy. Every single pullback was an opportunity to buy. Every single breakout was an opportunity to buy. As long as the Fed was going to keep rates high and Japan wasn't, USD/JPY was going to trend higher. And so every technical setup on that side, a pin bar, an engulfing, a breakout, a market technical structure breakout, became a high probability profitable trade. Why? Because you weren't just guessing. You were trading with the most powerful context in the market, the macro trend. And this is what a macro context does. This trend was random. It was the logical conclusion of a massive divergence between the two central banks. Find the divergence, find the trend. Now, this is one of the many examples about monetary policy divergences. They're real and they are some of the most powerful fundamental opportunities that you can trade in markets. Now, how can you do this yourself? That's the question. How can you know if a central bank is hawkish or dovish? Well, there's a method nowadays that allows you to do this in seconds. But hear me out first before I show you it. I don't want you to think this is a shortcut, an easy way of doing it, because the truth is that the more you research and analyze the market yourself, the more you understand it and gain confidence on it. So don't take what I'm about to say as the perfect way to do it. It's an efficient way to do it, but it has its downsides. That said, we need to know that there are tools out there that can do all the research for us nowadays. Obviously, one of them being ChatGPT. What I'm trying to go here with this is that you can use AI tools to analyze a specific central bank to know what they're going to do and what they're doing based on the current information. Because keep in mind that changes week after week. So you can just look at what a central bank is doing and projecting right now and just think you're done for a month. It changes as the data progresses, as the comments from a central banks come in. So the point is, with this prompt, with the right prompt, you can quickly find what the monetary policy levels are right now. So here's what you can ask ChatGPT. Now, this is the prompt you can use. This is going to output a summary of the central bank's tone and guidance, and on top of this, you can then conversate with the AI to get more information as needed. Now, I've done a full video on this to show you exactly how it works and how you can do this properly. Now, the question becomes, is this so? Is it a certainty that the market will always follow this mechanism of interest rate differentials? No. Absolutely not. This is just one piece of the puzzle. And it's a big and important piece, okay? But there's an even bigger piece to talk about. Another extremely important variable that dictates the flows of funds. Let me get into it. Okay, look at this. Why does a currency pair such as the Australian dollar against the Japanese yen move exactly like the S&P 500? Shouldn't a currency pair like a DJPY be dictated by the interest rate differential only? No. This is where most traders get it completely wrong with fundamentals. They learn about interest rates and monetary policy and they think everything is centered to that. But the truth is completely different. And I'm about to show you how. This USD/JPY chart overlaid with the S&P 500 in orange is the truth. See, we've talked about central banks and interest rate differentials, the fundamental story, value and yield, but that's not the whole picture. There's a third, even more powerful element that drives trends around and that overshadows interest rates and monetary policy. That element is global risk sentiment. Think of it as an economic growth sentiment. It can be positive or it can be negative. When traders are optimistic about global growth, they embrace risk. They buy risk assets, stocks, commodities, what we call high beta currency. Why? Because they're chasing yield and they're chasing growth and they're chasing risk. This is a risk-on type of sentiment. On the contrary, when things feel precautious, with growth slowing down, maybe recessionary fears, maybe geopolitical tensions, anything of that sort, they start to move into defensive assets, safe havens. This is the risk-off type of sentiment. Now in Forex, currencies are split into two baskets. High beta, the Australian dollar, the New Zealand dollar, the Canadian dollar, these do well in a positive risk-on sentiment. Safe havens, the Japanese and the Swiss franc, the dollar, this is where funds flow in growing uncertainty, recessions, geopolitical tensions and such. This is risk-off. Now on April 2nd, 2025, Trump did his famous Liberation Day. The day where he slapped every country with silly high tariffs. We're talking about a disruptive policy that suddenly increased global tensions 100-fold. Geopolitical uncertainty, supply chain risk, you name it. In simple, it wasn't just a move, it wasn't just a political move, it was a threat to the global economy. So with the risk sentiment mechanism I've just explained to you, what do you think should happen to a USD/JPY in this environment of escalating tariff uncertainty? Here, interest rates don't matter at all. It's about one single thing, risk on versus risk off. So think about it. Trump is shaking the foundation of the global economy with large tariffs. What happens? Simply, global markets, obviously they go into recessionary mode, so investors start ditching riskier assets such as the Australian dollar, favoring safer ones such as the yen, and obviously dumping also risk assets such as stocks. So money flows out of the Australian dollar and out of a high beta currency or assets like equities, and instead flows into the yen. The result, AUSD JPY goes lower along the S&P 500. And just to be precise, I'm talking about the Australian dollar against the Japanese yen here, but it's just an example. The same is true for all other currencies against the yen, because what is the Japanese yen? It's a safe haven. In other words, it's an asset that benefits from a risk-off sentiment. And the same is true for the Swiss franc and gold and such. See what's going on here? This is very important. This is not random. The sentiment here drives all markets. It's the same exact macro story driving all sorts of assets at the same time. US equities, bonds, currencies, precious metals, you name it. When things are shaky, so in a risk-off mood, traders move away from risk assets and rush into safe haven. Like Japanese yen, the Swiss franc and gold. All right, we've covered the weapons. We've covered the central bank, monetary policy, interest rates, and risk sentiment. Now, how do we actually use all of this to place a trade? Well, let me show you my framework. It's a simple checklist to filter out the noise and find high value, high conviction setup. First, you have to ask, what is the market's main story right now? What is the story driving the trend? Is it inflation? Is it a geopolitical escalation? Is it monetary policy? Is it a policy divergence between central banks? Whatever it is, you must identify the primary ongoing story. And once you know that, you can then ask the question, is the story likely to continue or is it near exhaustion? Now, listen closely here, because this is where it gets really interesting. If the Fed is explicitly stating that they will keep hiking rates until inflation is at 2%, and inflation is at 5%, is that narrative going to continue? Yes, it is. So your bias is to buy the dollar on a hawkish Fed. Now, on the contrary, if the market has been trending for months already on a story, okay, and then suddenly the tune is changing, is the narrative near exhaustion? Yes, it is. You don't ride the trend, you start looking for an opportunity to fade it. This is what fundamental analysis really is about. It's about building a thesis for the macro context in which we think the market will likely be. So we understand what's going on right now, and then we project ahead if the narrative is going to continue or not. That gives us a fundamental view of where the market is likely going to trend. Now, is this perfect? Obviously not. Knowing where the market is going to trend to and catching a trade at the right time are two completely different things. You might even know exactly where the price will move at a specific moment in time, but if you enter into that trade too early, into that direction too early, you end up with a stop loss or just a tiny profit. Now, this is where in fact we fuse the two words, fundamentals with technicals. I very rarely, if ever, place a trade on fundamentals alone. I have my fundamental bias, the macro story and the trend, and then I watch the chart, waiting it to give me the entry, the setup I want, the technical setup, breakout, trigger, whatever that I want. In fact, you'll see that pretty much all of our trades have a technical trigger. Anything like an engulfing candle on the daily chart, a breakout of market structure, whichever technical trigger you like to use, it doesn't matter. But you simply need to have that extra filter that tells you when to enter into the macro narrative. You see, a macro trend, no matter how powerful it is made of many pullbacks, many counter trend moves. And if you buy because the fundamentals say so, you might jump into the trade a little too early, and that's a problem, because you might be jumping right before a technical pullback, stops you out, and guess what? Right before the trend continues. The fundamentals gives us the direction, okay? The overall direction. It's the fundamental. But then the technical tells us when to enter in that direction. Technicals gives us the timing, and the macro story gives us the direction. When we combine the two, that's when we have a high quality trade. And instead, it's when we isolate the two that things get tricky. I mean, think of all the traders out there following every single technical setup that appears on the chart without understanding the fundamental context. Now, a technical setup is not necessarily a market signal. A beautiful technical setup with no fundamental backing is just a random pattern. It may or may not be formed by the type of market participants that you will want to follow, the speculative guys. Think about it. A perfect looking pin bar, a bearish pin bar on a chart formed maybe by a bank just edging corporates client currency exposure. They're not speculating. They're not positioning for market direction. They're just doing business. It has nothing to do with speculative positions. It's literally just noise. And so it just doesn't work. If there's no fundamental backing behind the technical setup, it's not a quality setup to take. See, this is where it gets really fun. No wonder why most traders can't trade consistently. What are they taught? Think about it. That news is noise. They're taught that they have to avoid the price action during news events. Seriously, this is the exact opposite. The price action during news events is the only price action that you should care about. So I have a simple rule. I have to be able to answer these 4 questions to take a trade. Point 1. Do I know what's going on behind the chart? What's the real reason that is moving the chart? Is it a political change? Is it a policy change? A geopolitical development? If I can't explain the fundamental driver in a simple sentence, I'm just guessing. So in that case, there is no trade to take. Point 2. Does the story have legs? So I understand the macro story. Now, is this something that's likely to continue ahead? Like if the Federal Reserve is going to keep hiking rates, they're going to stay hawkish? Or is the geopolitical context going to stay the same? Maybe it's going to escalate even further? Gotta answer that question. Point 3. Does the chart agree with my story? Now I look at the price action and I ask, is it confirming what I believe to be true? Is it confirming what I'm seeing fundamentally? Is it showing the same sentiment? Are the technicals giving me confirmation? The story tells me what to trade and in which direction to trade it. The chart tells us when. If they fight in each other, we gotta stay out. Point 4, is the risk reward acceptable? Even with a perfect story and a beautiful chart, if the risk reward is garbage, it's just a bad trade. Okay, it's not a trade worth taking, period. So realistically, can I make more than what I'm risking? Okay, if the market isn't compelling, it's a pass. That's all. If all of these 4 points are met, I have a quality setup on my hands and I can act on it with confidence. This brings me to the most important points. If you adopt this kind of macro framework, you'll find yourself trading less, a lot less. Most traders think that the key to success is more trades, more screen, more indicators, but that's simply a recipe for burnout. Trading less is boring. It feels unproductive, but you have to print this in your brain. Boring is profitable. Think about it. You're not paid for the number of trades you take. Your broker does. The more you trade, the more your broker gets paid with spreads, commissions. Every time you click, they get a share. Whenever a trade is a win or a loss, they get their share. So they're paid by the number of trades you take. You instead, you're paid for the quality of your decisions. And this framework forces you to wait patiently, to wait for those handful of times each month with the fundamental narrative, the macro trend, and your precise technical setup all aligned perfectly. Sometimes that's multiple times a week, in the same week. Sometimes it's just a couple of opportunities a month. You shouldn't care about that. You're not here to overtrade. You're here to make thoughtful and high quality trade decisions. So I hope this helps you see beyond the technical charts that most traders stare at. There's a whole ecosystem, a world of real macro events moving those lines on the chart. Understanding that world is what fundamental analysis is.